Welcome back to the Financial Shepherd podcast. You heard the music, so it's time for another episode. My name is Joshua Casey Garland, certified financial planner, owner of Shepherd Wealth Management. And it's going to be a heck of a day today as we got a lot to talk about. But before we do, anything on top of your mind? What do you want to talk about today, actually?
I think we're just going to let it riff here. I didn't expect to be this terrified this close to Halloween. So
yeah, well, it's a time for all of that here in October. And
I kid, obviously.
Time for some of that to happen here from a news standpoint,
right?
From a financial perspective. And that's going to be a big part of today's conversation. Obviously, we got a midterm election coming up, kicking off earnings season. We have a lot of inflation data that's already come out, more to come out in the coming weeks, and the Federal Reserve getting together for a little powwow on November 1st and making an announcement in the afternoon on November 2nd to let us all know that they're going to raise rates another 75 basis points again.
They got to get that kegger in Jackson Hole out of the way, though, before they make that announcement, you know?
Yeah, I think some of them are still maybe sleeping off all the good times they had out there in Jackson Hole.
Yeah.
Everybody was real fired up about being heroes to squash inflation when they were substantially behind the eight ball as it relates to printing $9 trillion worth of new money and calling it transitory.
Yeah, I heard,
blaming it on supply chain, which I bought, by the way. Totally bought that bag of goods.
Well, we've talked about this before. At the time, they couldn't think of a better solution. So it's not so much that we bought it. It was, what can we do right now?
It's not just that. I kind of put a lot of faith and trust in those that have more information and are more well-connected than any of us watching or listening to this program will ever be.
Right.
I don't have any ears and eyes in the Situation Room, in the White House. Unfortunately, I don't get to hang out with the Fed governors,
Yeah.
So we got to kind of take some of it at face value. And the honest truth is it was, I'm not going to call it a lie, but I think that there was a lot of blinders on to what was truly happening in reality, because there were some really smart folks. Wharton School professor Jeremy Siegel being one of them, basically pointing out that about 18 months after we printed all this new money, that there was going to be, an inflation issue, and he was 100% right.
Yeah.
And it's not just so much that he's been a economics professor at one of the best business schools on the planet for 50 years. It's just simply when you increase the money supply by that much, which rightfully probably was a fair decision to make when you shut down the global economy for nearly 2 straight years, and you don't want the entire economy around the globe to just completely collapse, right, and cause a ton of fear and panic. So I get why they printed the money, but to at this point to call it transitory and be in the seats that they're in, absolutely just not an acceptable outcome here, and we're all paying for it right now. So with that being said, to kick off today's show, let's go ahead and jump into this because we're going to have a lot of fun, I think, over the next, call it, month and a half when we do these shows, the podcast, the big ones that we're doing here today that we try to do every 2 weeks, the Financial Shepherd Happy Hour, which we do on Fridays about 4:15. There's going to be so much stuff coming at us that we really won't need to do a whole lot of prepping, I don't think, because it's going to be hitting us in the face. I'm going to turn on the mic. You're going to turn on the camera. And we're just going to let it rip here for...
It's going to be a ready, fire, aim situation. We're going to have,
Well, we're getting that right now. So as I'm talking into the camera, the President Joe Biden's talking about an increase in oil output, starting with releasing 15 million barrels from our strategic reserves. At that point, by the time that is depleted from our reserves, that will be about a third of the total reserves that we had prior to this releasing, of extra oil barrels into the market in an attempt to fight the gas prices that we're paying at the pump. Now, obviously, a lot of that worked. You saw that happen in the summertime. Price of commodities in general, but specifically oil, was coming down substantially. And they've now started to slowly creep their way back up. And coming into a midterm election year, you can see from an obvious perspective, even right here in this office in Florence, Kentucky, I can see it as clear as day. This is clearly a political move. I think anybody probably would have done something similar under similar circumstances. However, that's certainly not going to fix the problem. It's just is putting a very small Band-Aid over a very gaping, gushing hole from a supply standpoint. And that's really how these things trade. Of course, there's a ton of demand for energy and oil around the globe. That's a no duh, but the issue here is supply, and that's why they're going to release some additional barrels. Because OPEC, about a week and a half ago when we did the last podcast, announced a 2 million barrel per day production cut, which truthfully was really about 1 million barrels roughly, because there were already several countries in OPEC plus that weren't actually meeting quota anyway. So that's the reason for that. But that's the headline news as we're actually going through this podcast right now. On top of all of that, we did get some new data today that new home construction fell by 8.1% in September. Obviously, this has a lot to do with the interest rate increases that the Federal Reserve has already made, over 300 points in interest rate increases so far this year. And that is definitely going to curb demand for things like new homes, even existing homes. Right before we got on the show today, I already had a data point here. 30-year mortgages, 6+%. Well, actually, just a couple minutes ago, for the first time since 2008, we now have a 30-year mortgage at 7.2%. So that's the reason why the Fed jacks up rates, or at least one of the reasons, is they want to slow demand. And the housing market is one of the biggest components of the calculation for the inflation data that we get about every month.
Yeah.
Unfortunately, even though the Fed is hell-bent on raising rates, at least another 100 basis points, maybe 1.25% more, so 125 basis points maybe might happen too. They do that to curb demand, but man, this is not going to show up in the inflation data anytime soon. And they know that.
Yeah. Yeah, I mean,
it's frustrating.
That whole relationship is frustrating. It's hard for me to come up with something witty to say immediately, because we talk about this all the time on the podcast, how there are people even, at the last interest rate hike saying, okay, chill for a sec and let's see how this gets absorbed into the actual inflation.
I don't think that we're going to see that pause that I've been asking for, that a lot of others are asking for. I'm not saying let's start cutting rates. That wouldn't make a lot of sense to me. But to pause and actually let some of this work its way through what is a very complex global economy. Right. We live on a monetary planet. Well, monetary policy, unfortunately, does not just, flip a light switch. We increased interest rates. Now supply and demand becomes an equilibrium. It just doesn't happen that quickly. Everybody that's on the federal governor's board that gets a seat at the table with Jerome Powell to make these decisions, they all know all these things, and they hear everything that Professor Jeremy Siegel has said. He said the exact same things that I've been articulating, and a whole bunch of other folks are asking the Fed to do the exact same thing. But they're completely independent. At least they're supposed to be completely independent from Congress and the White House and everything else. But we're coming into a midterm election year. They're going to do what they need to do as far as fighting inflation, but just because they raise rates here on November 2nd does not mean really anything in the short run, because it does not fix the biggest issues that we have, which is trying to get supply to be increased for oil, food, natural gas, houses. We're about 5 million short in homes. I mean, all these things don't take a week or two or a quarter to resolve themselves. It takes a lot of time.
Yeah, 100%.
And that's something we're going to talk a little bit more about here. But we're right at the beginning of earnings season. And historically, the last quarter of the year, which is what we're in right now, October through December, typically the best quarter for equities of all 4 quarters throughout the year. But some interesting data points that I wanted to share with everybody today, which is a big reason why we do this show, by the way, for those that may be watching, listening to the first episode here, is we do all this stuff because you're going to hear some of the headline things that we talk about in the news or in, whatever it is that you subscribe to from a journal or newspaper standpoint, if people still buy those these days. I know I do, just because I like to get that little, newspaper about once a week. And it's nice to have something to read other than whatever's on my computer screen.
Yeah, that backlit glow, man. You got to take a break from it. I'm still a sucker for books, and I actually still have one magazine subscription I get. So
yeah, cool. I don't know how much longer that industry's got to go, but I'll be one of those guys hanging on there for a little while. Anyway, so earnings season, the average earning result thus far is 5% higher than the estimates for analysts. So basically, Of all the companies that have reported earnings thus far, they're doing better than what analysts had expected by about 5% on earnings and revenue, which is usually the two most important things that investors are looking forward to when they make these announcements. However, despite these results, the average stock price return the trading day after companies beat on both the top and bottom line is down 0.4%, so nearly down half of 1%, even though companies have reported earnings that are about 5% better on average than analysts had expected on both the top and bottom line of their reports, which is a little odd to say the least. But even worse than that, if you were to miss either of those two metrics, revenue or earnings per share, the average loss that you see the next day for those shares is 7%. So what does history have to say about that? Well, in the last 5 years, companies that have beat on the top and bottom line for their quarterly earnings, they saw an average gain of 1%. So what is the deal here? Numbers are really good. We got 40-year high inflation. We got all kinds of issues, both here in the United States and globally. And yet, despite all of that, corporate America has figured out a way to do much better than what others in the same industry had expected of them. But yet their stock price is suffering, even though they beat. And if they don't beat, by the way, they just really get smacked in the face from a share loss in value standpoint, right? Immediately. So why is this? So this was a question that was asked to me by clients, and I do client quarterly reviews in person, if at all possible, every single quarter with every one of my clients. And this is a topic that came up saying, hey, earnings have been good all year long, at least on average, about 70% of those companies that do report so far this year have either met or exceeded analyst expectations, yet, the market's off more than 20% in the S&P, more than 30% in the NASDAQ, et cetera, et cetera. And the reality is it really doesn't matter how good the fundamentals of these companies are.
Right.
It really doesn't matter if they post, record revenue. It's going to be blamed on all inflation's at a 40-year high. It doesn't really matter, at least in this moment in time, that earnings are so good. Long term, earnings are for sure one of the very most important things that make the market move. And over time, we know the market moves typically on average at about 10% clip, which means some years you're going to do a lot better than that. Some years you won't make any money at all. But that's the historical average of the S&P 500 over the last 100 years. However, in this particular year that we've been going through so far, investors haven't really cared about what the earnings have looked like because they're worried about all the other things that they cannot control, like 40-year high inflation, supply chain issues, geopolitical problems. We got a midterm election. We don't know who's going to win. We don't know what the monetary policy is going to be, going into 2023, because we really don't know the effects of the interest rate increases we've seen so far and how that's going to affect corporate profits. So many things. They call it a wall of worry, on Wall Street. Investors have to climb the wall of worry. And that's exactly what they're trying to deal with right now, which is why you see the University of Michigan consumer sentiment surveys roughly every month. They've been doing this since the 50s. Well, you got the lowest numbers from a sentiment standpoint than they've ever had in the history of them recording the data.
Yeah.
Right. So it hasn't really mattered if corporate profits or earnings or revenue or whatever metric we want to look at has been so resilient in the face of all these things. To me, that's like super encouraging. It gets me a little fired up as a long-term investor, because if we're able to handle all of these things, just like we've handled every other thing that's ever come out, such as the dot-com bubble burst when the internet got hot, or God forbid, the great financial crisis was a hell of a lot worse than what we're actually going through right now from an economic standpoint.
Yeah.
Right? Banks that have been around 150, 200 years, failed, gone, just evaporated.
I can remember that stretched so far into everything. That was 2008. I finally, left school, finished my graduate degree, and
good time to get out of school, right?
Exactly. No job opportunities. I can remember walking up and down the street in the neighborhood I was living, going into every place, asking, what do you have available? Like, I'll wash dishes, third shift, no one hired. I mean, it was months of that.
I got laid off. I was working in a factory trying to wrap up school.
There you go. I mean, I can't even, it was one of the worst experiences I've ever been through.
And this isn't it, right? We got other issues here, but we don't have a banking crisis.
Right.
But yet you have individual human beings, and that's what the market is. So we can make all this stuff super complicated, and we do we do a little bit of that too much sometimes in my business as an advisor, pointing to all these different metrics, standard deviation, 200-day moving average, all this stuff. It's fun to talk about. I like it. A lot of people might not
say yield curve.
Simply put, what is the market? It's a bunch of people putting their capital at risk. That's it. And they make decisions with that capital. Well, who's making that decision? A human being is. Mm-hmm. You could say, yeah, you got algorithmic trading and computers and quants and all this stuff. Yes, that's true, but a human being had to put in all the information for that computer to make decisions. So yes, there is capital at work. Money is a endless resource. There is no question about that. We just kind of proved that in 2020 with all that printing of new money. But human beings at the end of the day are what makes up the market. And it's fascinating that you can literally watch the market on a second-by-second basis. And really what you're watching is a live autopsy of human emotion around the globe.
Yep.
And that is actually encouraging because human beings, since the beginning of time, let's call it 2,000 plus years, we really haven't changed at all, right? We've repeated so many mistakes. I'm not blaming anyone in particular. I'm just saying what the facts are. We've kind of repeated ourselves over and over and over and over again. And the market has repeated itself over and over and over again. So about every 4 years, we typically have a bear market or some sort of negative year from a performance standpoint. About 70% of the time when you wake up on January 1, there's a good chance 70% of the time that you're going to have more money at the end of that calendar year than what you began with. So the market typically is positive about 70% of the time. However, almost every time we have a midterm election year, the market is generally negative leading up to that actual election. And then it has a nice rally for about 8 to 9 months. And then we start to climb that wall of worry again when we go to the next actual presidential cycle. So at the end of the day, let's just make this simple. Our capital needs to be in the market for a lot of reasons. We're going to talk about some of them here in just a minute. We have to make decisions with our capital based on economic data, political information. But at the end of the day, these cycles are very much predictable. It doesn't guarantee that you're going to be a successful investor because the market tends to repeat itself from a historical standpoint because it's made up of a whole bunch of human beings and we're all broken to some degree. And we all know, at least we should know if you've been watching this show since we started this, that human beings are hardwired with fear and greed.
Fear and greed.
Fear and greed. And we know that human beings feel our losses twice as much as we feel good about our gains. And as an individual investor, we should actually be encouraged by all this information because if it's true, now we can begin to prepare ourselves accordingly. And that's exactly why we do this show, is say, yes, the news is right. These are all the things that you should be concerned about, to say the least. But this is not the first time that we've gone through some sort of similar pattern in the history of our global economy, and specifically right here in the United States. And that's kind of be the focus of almost all of our podcasts, is saying, yes, this is what you're hearing in the news, but what the news does a poor job of is providing some historical context around that. That way you can kind of prepare yourself both mentally and from a investment standpoint to handle what history tends to repeat itself for. Mm-hmm. So with that being said, as in the past 5 years, when a stock beats on the top and bottom line, it averages a 1% gain. That's great, but we're not seeing a lot of that right now. So let's go back in history a little bit more. The S&P 500 has this price to earnings multiple attached to it. Well, we started the year at about 22% price to earnings multiple on the S&P 500. It has since fallen back to about 16, which is right in line with historical averages. And if you were to strip out the top 8 companies from a market cap perspective, so really the largest 8 companies that represent the S&P 500, that price to earnings multiple comes down to about 14. Well, the average price to earnings multiple over the S&P 500 for the last, call it about 100 years, is right around 15 and a half, 16. So we've had enough pullback from a historical perspective to say, yeah, we're getting at least a fair value on prices of equities. And if you see further pullbacks in equities, just know that you're probably never going to pick the bottom, but you're probably not that far away from what will likely be a bottom. If we haven't seen it already, which we certainly could have already seen a bottom. Who knows for sure? We won't know until about 3-4 months after the fact. But relative to what history would have to say, you're going to get a pretty good deal for the long-term stockholder. Now, with that being said, coming up next week on Thursday, we're going to get some more jobless claims numbers. We'll also get some additional information for initial jobless claims, as well as the Friday report for the University of Michigan consumer sentiment. In addition to that, next week is loaded with earnings reports. We're looking at 1,500 approximate companies that's going to be reporting earnings.
Wow.
And we're focusing on a few of these. I'm going to rattle them off here real quick. So Monday, we're kicking off with Discover Financial Services, the credit card company. A lot of people tend to forget that Discover is one of them. It's usually either Visa, MasterCard, or Amex.
Yeah.
People tend to forget about that one. Very important. And it kind of gives us an indication of where the consumer is.
Yeah.
Right?
Yeah.
And Discover tends to go after a higher quality consumer from a credit standpoint. They have a little bit of a leaner balance sheet than a lot of their competitors. They tend to not take on as much risk. So I'm interested to see what that looks like. Also because we're shareholders of that position here as well. So that'll be a big one. Tuesday, huge day. We got Google announcing their earnings. Sherwin-Williams, which is going to be key for us, not just because we're shareholders, but Sherwin-Williams was one of those companies that truly did suffer from the supply chain issues that we were kind of going through. They really, truly could not get enough paint. And as everybody knows, when you're sitting around your house for 18 months, 2 years, you're looking at all of your stuff saying, man, this has got to go, or I got to fix this.
Right.
And they benefited from the pandemic, but they also significantly, fell short from a supply standpoint. So probably could have done a lot better as well. So I'm interested to see what their CEO is going to have to say about things like supply chain, but I think their numbers will probably be pretty good. Microsoft as well is on Tuesday. Big day Wednesday. Apple, after the closing bell, is going to be making an announcement. Apple's the largest holding in the S&P 500. It's about 7% of that index weighting. So that's going to be a big market moving day.
Yeah.
With just Apple's report in and of itself. And by the way, if Apple has supply chain issues, that probably means virtually everyone, still dealing with the same thing. So that'll be key too to hear from Tim Cook. Thursday, we got Amazon, which I'm very much excited to hear what they have to say leading up to their busiest time of the year, really, with holidays. They had their Prime Day already.
They make boxes, right? That's what that company does.
I have to go back and check exactly what it is. But no, in all seriousness, their AWS has been like a rocket ship from a performance standpoint. I mean, that's really where most of their profits have come from so far this year. So I'm interested to see a lot about what Amazon has to say, not just on wages, right? Supply chain, the cloud business. There really hasn't been a recession in the cloud at all. Based on their numbers, and not just them. So Microsoft, Google, and others have really had stellar cloud numbers all year. And I'm just interested to see what they have to say about the consumer as well. So you're going to get it on Monday with credit card information. Going to kind of get a little bit more with that with Apple and Amazon coming in Wednesday and Thursday with their earnings. And then Friday, we're wrapping up with a whole bunch of energy companies. They're going to knock it out of the park. They'll probably have one of the best quarters that they've ever had coming up here, as well as some healthcare companies, AbbVie being one of them. So there's 1,500 reasons next week to either be excited or super depressed, depending on the actual results.
Why not both?
Which is actually a decent segue. So I, again, expect the energy sector, even though it's the smallest sector of the S&P 500, to have a really strong quarter, really strong finish to the end of the year, probably a good start to next year. With all that being said, the supply and demand dislocation that we've seen here from an energy and commodity perspective is not going to last forever. This is not the new normal in any way, shape, or form. Hopefully, there are even some, Congress and White House and everybody that's, going to go up for election can kind of see the importance of energy independence, agricultural independence, and simply just having the workers that we actually need to be able to do the job. So there are hopefully some actual policy decisions that will come about after this midterm election, which is a big reason why midterm elections tend to have a nice rally after the fact. But I do expect the energy market to do very, very well. And the anticipation here, even starting today, is going to start to unwind some of those holdings and using that capital ready to be redeployed back into parts of our portfolios that have performed the worst, and the worst performing sector this year is by far and away technology, which just happens to be the biggest sector of the S&P 500. And for that matter, the most important sector, because it truly does affect every part of all the 11 sectors in the S&P 500.
Right. And we talk about that on the show a bunch, just how pervasive and interconnected technology sector is. And also, think of any kind of issue, crises, thing that needs to be solved for the future. Technology is going to be a part of it. So that's obviously.
Yeah, 100%. So we'll use some of that money. And so we've really been overweight 3 areas. And we have a nice diversified portfolio here for clients and always will. So we've been pretty much overweight energy, healthcare, and tech. Tech has been rough. Healthcare as a sector is actually down, but there are definitely parts of it that are profitable. United Health is one of them. And then, of course, the energy space is the only sector that's been positive this year. So we have to take some of those profits off the table. Today's been a nice pop in energy today. I'm probably going to, after the show, take some gains off of energy, free that capital up to add to healthcare as well as technology. Healthcare being the way to play offense and defense here in a volatile market and likely a recession in 2023 at some point in time. At least that's what history would have to say, with an inverted yield curve and tight monetary policy. So with all that, we're going to do a little bit of rebalancing for clients. And I know we talked about this in our last podcast, is we actually, for the first time in a long, long time, had a really in-depth conversation about adding fixed income as a holding for a well-diversified asset allocation for clients. And for those that are in retirement, we're allocating a little bit there in a laddered fashion, taking maybe 15, 20% of someone's portfolio holdings and adding it to that space. But for those that are not in retirement, or even those that are in retirement that really have no use for those funds and are looking for long-term growth, then equities are certainly going to be the place that you want to be, because they've historically been able to outperform inflation and every other asset class by a very wide margin. And for most folks that are in retirement, inflation is their number one enemy outside of their own personal health, right? Because healthcare costs tend to not go down, and it keeps getting better, and people are living longer because of that, but it doesn't make it less expensive. At least not today. Maybe there's a better solution for healthcare costs well out into the future. I won't be the guy that comes up with that, but certainly, hopefully, somebody else will. I know others are trying, Mark Cuban being one of them, but
yeah, I'm a big fan of his efforts into the healthcare. So
no doubt. So we got a whole bunch of earnings coming up, some things that we can do from a rebalancing standpoint to kind of prepare for what will likely be a very nice rebound. At least that's what history would have to say post midterm elections. So why do I want to take some profits off of energy and maybe even healthcare, is because of what I'm about ready to go over with everyone here. So generally speaking, in a volatile market year, having exposure to equities doesn't actually feel all that great. Well, this isn't all that uncommon in a midterm election year. The average drawdown in the S&P 500 during a midterm election year is 17%. Great. Post-midterm election, what happens? Well, now that we have clarity back in the market again, there's a little bit less uncertainty, at least from a political standpoint. You should expect, at least what history would have to say on average, is the S&P tends to grow somewhere in that 16 to 20% range post-midterm election for the next 12 months. So that's encouraging. And if you're going to have a sustainable market rally, well, certainly technology has to play a significant role in that.
Yeah.
There's no way that you're going to have a sustained market rally and tech's like, no, I'm not playing. I'm just going to stay down and keep losing, share value or price value on my stocks.
It's a personal day. I don't feel like it.
Yeah, that's not going to happen. So I want to take this opportunity to free up some capital, invest some of that early into tech shares, and kind of expect that rebound to happen. Now, with all the earnings that are about to take place here, I'm in no big rush. I may go ahead and take some profits off of energy and healthcare right now.
Yeah.
Not all of them. And I may not necessarily throw all that capital, definitely won't throw all that capital into tech leading up to earnings, because as we've already read here, it's really not about what the performance is. It's about how the investors in the marketplace are hearing what the CEO, the CFO is actually saying about those results. Are they sustainable? Are they pulling back their guidance going into 2023? Are they coming out saying, hey, I don't really know, our history says that we should do this. We kind of feel good about it, but we don't really know because of all these reasons, so therefore we can't give you any guidance, coming into January and February of next year. Like that's really what's going to hit consumers' confidence about taking the risk to put their capital into the marketplace. So those post-earnings announcements by the CEOs, the CFOs, those actual analyst calls, which you can listen to either live in time or after the fact, freaking nobody does that. At least when I was working at some of the largest places, for people to invest in, I never heard anybody saying, yeah, you know what, I had to TiVo the first 15 minutes of the football game tonight because I wanted to make sure I heard Tim Cook talk about, their earnings. Like that never happens, right? Never, even though you can listen to it after the fact. But that's part of my job here, so I'll actually be listening to all of these things. So I might not put a whole bunch of that capital from selling energy and healthcare into tech right away. Probably going to leg my way in there.
Okay.
And even if I miss the first 5% of, let's call it the next bull market rally because I didn't just take all the funds and dump it in there, that's okay. I mean, the NASDAQ is off 35% year to date. I'd be happy
to get that 30.
The 30 too. And I think all the other clients would as well. So we've been anticipating these things all year long. Now you might be saying, why don't you just take all the money from energy and healthcare, sit on the sidelines, wait until that actual true recession comes around in 2023, which I am, calling for.
Yeah.
But the market's not stupid. It's trying to price in a recession in 2023 right now.
Right.
Generally, the market's looking out 9, 12 months down the line. At least they're trying to look out that far ahead and figure out, okay, if these things actually line up in place, what's the value of this company today? Mm-hmm. Right? They're not necessarily just doing some sort of discounted cash flow model, some sort of net present value calculation. Yes, that is a part of it. That's a part of coming up with a value for a company, but you're also looking at the actual macroeconomic environment that we're in today, and based on what the Federal Reserve has done and what may or may not happen post midterm election, that's what the market's trying to figure out. Which, by the way, we're a bunch of human beings, and that sounds super complicated. Well, it is, right? How could you possibly expect any human being on the face of the planet to take all this information, take it in as it's coming in live time, and then price in thousands of different securities across multiple different sectors in a very complex and global economy? It's very difficult work. That is the understatement of the year so far for this podcast. However, we don't need to own everything all the time. We can take a diversified approach and maybe narrow our focus to the sectors that we should expect to do well, both in recessionary times, healthcare being one of them. And you can say, okay, well, what is the largest healthcare companies on the planet? You can look at the S&P 500 healthcare sector ETF to get an idea of what that looks like.
Right.
And if you want to own the individual positions, okay, great. Now you know what the largest one is, right? You can start to make comparisons to their peers. That's an easy way to go about starting to do that research. So hopefully that helps for all of you folks that do not want to listen to analyst calls, but it might help you narrow down your focus a little bit as well. Now, the other point is, why not just take all that money out of energy and healthcare, sit it in a 6-month treasury, and then invest that? Okay, that's a way to do it, but you also have to take this into consideration. We talked about this in our last podcast show, is that 78% of the stock market's very best days come during a bear market or at the very beginning stages of a bull market, which, by the way, you won't know until 4 or 5 months after the fact. So time in the market is so much smarter than trying to time the market, and you can't argue with the data. I mean, if you had 11,000 trading days, which is the last 30 years, and you were to miss 10 of those days, 10 of the best days out of that 11,000, I mean, your return gets cut in half at the end of that 30 years. So you cannot just jump in and out of this thing. And if you try to do that, I mean, that's the reason why you get all these reports from virtually every large brokerage company. Vanguard does it every single year, this Dalbar study saying, hey, here's what the retail investor's average return was versus the market. And it's almost always 3 or 4 percentage points worse off than what the market had done. So trying to time the market, complete waste of time. The other thing that we spent a lot of time talking about in prior podcasts as well is just this blanket approach to investing. So a lot of people, and I understand why they do this. So I've seen, I don't know how many 401k accounts in my career. I worked at some big places that had a lot of those. And almost every time, not every time, but a very, very high percentage of the time, when you look at somebody's 401k or 403b or whatever the company retirement plan is, there's usually an option for a target date fund. So I don't know if you've heard of a target date fund, but I bet most of you watching and listening to this probably have it, one of your retirement accounts. So a target date fund, what is it? So pretty much everybody in the mutual fund world or ETF world has what they call a target date fund. So I'll just pick on Charles Schwab, since that's where we custody accounts for clients here at Shepherd Wealth Management. So Charles Schwab has what they call a Charles Schwab 2050 target date fund. So all that means is the closer and closer we get to the year 2050, the more conservative that asset allocation becomes, right?
Okay.
So since we're so far away from 2050, you can imagine the allocations heavily tilted towards growth, right?
Right.
And it'll very, very slowly start to get more and more conservative. So we'll have less and less stock exposure, more and more bond exposure. I would be willing to bet right now that about 85% of that 2050 fund is in equities, the remaining in fixed income, right? Sounds nice. Simple way to get an asset allocation that would be suitable for those that might be looking at something like retirement in the year 2050, right? I mean, that's why it's there. That's why that vehicle exists, is because it allows you to set things up on autopilot, nice, well-diversified asset allocation. And as you get closer to that goal year, call it retirement 2050, now you have a more conservative portfolio. In theory, sounds great. Here's what the problem is with that. First of all the underlying mutual funds inside of your target date fund, in this case, Charles Schwab, what's it made of? It's not made of individual stocks. It's made of a whole bunch of different Charles Schwab mutual funds. Some will be designed for growth, some will be designed for value, some will be in international, some will be in different fixed income products, right? But there are let's call it 15 different mutual funds inside of this one target date fund.
Yeah.
Right? So you're adding more cost, right? Mutual funds historically are a more expensive way to access the market. So that's an issue. And the other issue that I see there that's kind of obvious to me is that, at least in this product, that Charles Schwab is using all of their own mutual funds to create it, right? Or Charles Schwab funds, always the best funds all the time for everybody? Answer is no, but they're trying to make it simple, right? For the consumer, or in this case, the 401k participant, at Kroger or whatever the company is that has the 401k. Now, the other issue, and this is really the biggest issue that I have, maybe the second biggest issue, other issue that I have with this is that fund manager that's running that Charles Schwab 2050 fund, well, they're making decisions with that asset allocation really based on one thing, and that's time.
Right.
We're getting closer and closer to 2050. Oh, I got to get more and more conservative because of the way this thing's packaged and sold to the underlying investor. All right, this is the biggest thing that I have against those target date funds. It's such a microwave-ready solution. That's what makes it attractive, because most, Americans, this is not, the investment world is not something they have a lot of time, energy, or desire to be an expert at. 100% agree with it. There's a million things I'm awful at, and I would never claim to be an expert at. And I don't want to spend the time, money, and energy and effort to be an expert at everything. So I understand why the finance world packages, a microwave-ready way to invest. But that cookie-cutter approach to, I'm always and forever going to have exposure to X amount of fixed income or X amount of international or X amount of value or growth, to me, that's so dumb.
Yeah.
Right. It made no sense coming into this year. You did not need to be, a Harvard economics graduate to know that bonds were probably going to have a difficult time making money for people when interest rates are going up.
Right.
Fair. I didn't know there was going to be a geopolitical event going on in Ukraine. Clearly, nobody did. But there was a lot of writing on the wall that there was going to be some issues from an economic standpoint for a lot of countries outside of the United States. And a lot of it had to do with what happened with COVID. Right. So not their fault, kind of justifiably so. I didn't know it was going to be as bad as it was, but I can kind of see some reasons to say, okay, well, if bonds are definitely not going to make any money and international is going to have a really rough time, where else can we go? So I defaulted to U.S. publicly traded companies. Even for those that are in retirement or approaching retirement, You might say, well, what kind of sense does that make, having 100% equity exposure for those folks? Well, we just kind of went through the test here. Fixed income wasn't a viable option. Fixed income's down 15% year to date. And we spent an entire podcast talking about how terrible a 60-40 asset allocation performance is, the worst of all time.
Last episode.
Down 26% on a 60-40 portfolio. I mean, that's worse than the S&P 500.
Yeah.
The whole purpose of that asset allocation is to be able to do better than the S&P 500, specifically in a bear market. Because of that fixed income exposure, it didn't work out. Right. So that kind of blanket approach to I'm always going to have X% in this, international space or this fixed income space or this value or this growth, that's just a lazy way to go about investing. And laziness has hurt you this year in a big way, which is the reason why, I have a job here, and the reason why a lot of people like to do business with us here at Shepherd Wealth Management, because it's not just about making money. Number one, we're here to do a service. We're here to take capital and actually make a difference in our local community and around the world. But the only way that we're able to do that is to perform for our clients. And for me to perform for my clients, I can't take a cookie cutter approach to things, right? We got to take a real hard look at the circumstances that we're in here and say, okay, well, based on your specific goals, risk tolerance, time frame, and your comfort level with everything that's going on around the world, here's an allocation that will make sense for us in the short, intermediate term. And in the long run, we know we want to get to this target allocation, but we can get our way there over time, right? So you probably, those that are watching and listening to this, if you have those target date funds in your account, give me a call. We can chat about it, 513-630-2664. So with that, Ez, we got to get to some questions here.
Yeah.
I got some people calling me right now. So I'm going to go ahead and take the questions that we got already.
All right. Well, returning texter, Pooja from Cincinnati. If the U.S. really is energy dependent, why are we so susceptible to foreign influence regarding energy, gas prices, etc.?
That's an excellent question, because why should we be knocking on the doorstep of OPEC, in this specific circumstance, Saudi, and saying, hey, please, either don't cut production, or what we'd really like to see is just don't cut production before the midterm election.
Yeah.
Right. How, for me as an American, I just feel saddened by that is probably the best feeling that jumps to the forefront of my mind, because we are and can be very much energy independent. We essentially are, but yet we're still going hat in hand saying, hey, we could use your help here from a oil price standpoint. We need more of your production. That makes no sense to me. We can get it right here in our own backyard. But more importantly, why can't the rest of the world look to the United States to be a solution? Why can't we sell these assets, natural gas, liquefied natural gas, oil? Hell, we can make as much food as we probably want to, right here in this country, to be able to help out almost everyone around the world. Not obviously everyone around the world needs that, but there are definitely some places that certainly do and could definitely use it in a big way right now. So I look at all of these things, and to that question specifically, really what we have to be willing to consider doing and accepting as a country is what does your quality of life look like without some of these things? Well, just pick up the phone or go visit someplace in Europe right now, and they'll tell you, right, what kind of quality of life they would like to have would be completely energy independent from Russian oil and gas. I mean, that's the reality. They basically have sanctions. They do have sanctions right now saying, hey, we're not going to buy it. Obviously, I think everyone would agree with that conclusion that they came to.
Yeah.
But they don't have a quick solution. And we don't have a quick solution here. But what I'd like to see, really an answer to that question, is just leadership, man. Just come out and say, we know that we still have this goal of clean energy, zero carbon footprint by 2050. That should be the standard goal for our globe here, right? If we want to, be able to live on this planet and see our kids and grandkids be able to have a nice quality of life, then yes, we do need to deal with things like carbon emissions. However, in the short and intermediate run, these are steps that we can take to make sure that we never have to experience what we're experiencing right now, so that Europe and other parts of the world never have to experience what they experience right now. And I think leadership could just simply come out and say, regardless of whatever happens in midterm elections, this is not a political show. I'm not advocating for any of that, but what I think leadership can do, what a leader is being proactive, saying, I feel the pain, regardless how it affects me from a polling standpoint or whatever. Here's some things that we can actually do today to hopefully not have this happen in the future. Let's go ahead and, come up with a good solution for the oil industry to make sure that they don't lose the billions of dollars that they would have to invest in infrastructure to actually increase production, right? They're worried about the fall in oil and gas prices from where they are today to make them an unprofitable investment, right? If you're going to spend $2 billion making a refinery, as an example, and you're not for sure what's going to happen with the price of oil, well, there's got to be a way for the federal government and governments around the world to come up with a cap price or something. There's a solution out there. That's what these people got voted for, right? Sit around a room and think about it, come up with an answer. And that's all you would have to tell the public is, I know that we don't have a solution today. This isn't going to be fixed tomorrow. This is going to take freaking years, all right? But we're doing something proactive about it now.
Right.
That's it. That's all you have to say. So I hope that that's actually what ultimately will happen post midterm election. Who knows though? Unfortunately, all we can do as individual human beings and investors in the marketplace is show up at the polls and vote. But I don't think that it's not a Republican Democrat thing. This is just, hey, we got these problems. Let's actually come up with a solution instead of pointing the finger at all these other issues and countries, when truthfully, we can just point the finger right at ourselves and say, you know what, forget the rest of the world. Forget what's going on over there in Saudi Arabia and OPEC. Let's just come up with a solution here, and everybody else that wants to have some part of that solution or benefit from that solution, we'll be able to accommodate that, either from selling those things or working, together to better the situation that we're ultimately in from a commodity, agriculture, and production standpoint. So hopefully that helps. That was a long-winded answer, a little bit of a rant there, but it's kind of how I feel about it.
It's your show, Josh.
Yeah.
All right. Well, we got time for one more. Brian from Shelbyville. Long-time listener, long-time texter. Do you anticipate an immediate drastic shift in the market following midterm elections, or will it be a slow burn?
It's going to be pretty dramatic, right? I mean, that's what history would have to say. That's my anticipation. That's what I'm preparing for from a positioning standpoint for clients and for myself personally. I think that the evidence is already there from earlier this year. Is yes, things are way oversold. People are way too pessimistic. That's a good thing if you understand all the things that we're talking about here today. But in the June lows earlier this year, so we've surpassed the June lows, but in June at that time was the market bottom, right? Obviously that was not correct, but we started to get a rally mid-July through about mid-August. So that 3 or 4 weeks there, we got half of the losses back from the prior months of 2022. So within a 3 or 4 week span of time to get half the losses back just tells you how fast the market can move in the other direction.
Right.
And I think that you're going to see that right after the midterm election, because we'll have that clarity. Hopefully we'll ultimately see inflation start to come in the direction we'd like it to go to. I believe that corporate profits, corporate earnings are going to be good, even though a lot of people don't seem to care about that. But ultimately, that is going to be a big driver for the market in the long run. So I do expect a very rapid snapback post-midterm election here. So I would plan accordingly in the portfolio. And typically what you would see, I'm not calling a bull market after the midterm elections, but typically if you're expecting a pretty nice rally, and if you look at history, we should kind of at least anticipate that.
Right.
Even though past performance is no guarantee of future results. So I got that in there for all you regulators watching here. But typically you would see small caps, specifically small cap value, have a significant rise. Mm-hmm. A lot of it has to do with the fact that small cap companies typically are domestically focused. So they don't have that headwind of the dollar appreciating in price because they're typically not sending their goods and services outside the country. So that might be a place to look to add to, or, actually hold in your portfolio if you don't already have that position. And then the second one being, like we've already talked about, tech. It's been the hardest hit so far this year. And that sector is so large and important, it has to be a part of that rally. So you can definitely get a lot of nice value there as well. So that's the anticipation I have. And hopefully that helps everybody else as well.
Yeah.
As we've kind of got through 50 minutes, I don't even know where we began, but all I know is we've landed this bird. And I think that a lot of people should feel very bullish about the future. I think a lot of people should be very bullish in the intermediate term from an investment standpoint. And I plan to take advantage of all of those that have this very, very, very bearish sentiment. Now, we could be wrong here, right? And all those bears could be 100% right, but this is not the new norm of lower and lower and lower in the stock market. Eventually, that all turns around, and I'm going to be positioned to take advantage of that for clients.
Yeah, I mean, at some point, the bears go back to sleep. You know,
that's right.
And they've been awake all year. I'm ready for them to hibernate.
Well, I think next week is going to be a big player in that. As we talked about 1,500 plus companies and earnings, and then that's not even close to being done. So I'm very excited for next week. And don't forget to check out the Financial Shepherd Happy Hour, Fridays about 4:15. We can't get to them every Fridays because we're either gone or there's, specifically if Ezra's gone, then I have this technology issue.
We're talking ourselves off bridges sometimes.
Yeah. But don't forget to check that out, 4:15. Basically, we'll wrap up the week there. We'll definitely be very excited to do that in the next several weeks because of so much information coming out there. And then we plan to do our next big podcast show, the Financial Shepherd podcast, on Thursday, November 3rd, post the Fed announcement on November 2nd. So
a lot to talk about there.
So much. We'll be going through not only next week's mega earnings week, the week after is going to be a big earnings week. We'll get more data on jobs and so forth, and then the Fed coming out. So
week before midterms.
Yeah, a lot to get to. Very excited for that. So send us your questions ahead of time if you'd like to. 513-630-2664. My name's Joshua Casey Garland. My friend Ezra on the other end, all the video editing effects that you see, that's all him. So we love what you do. It's awesome work.
Love doing it. Love being here.
And we'll look forward to doing this again in a few days. You guys have a great rest of your day.